So this video is called Will US Real GDP Growth Ever Get Back to 3%? We'll start by looking at trends in real GDP growth. Next, we'll look at the components of GDP growth. Then we will explore the three key factors impacting long-term growth. And lastly, we will summarize with a long-term estimate of GDP growth. This chart shows real GDP on a log scale. It has historically grown at about 3 to 4%, but the last 15 years have been below trend. This is the year-over-year change in real GDP, shown by the blue line. It's a bit hard to tell, but it's going down. The red line shows the rolling 7-year average. We'll show a close-up of that in a second. And the black line tracks the peaks, and that has been declining. This is a closer look at the 7-year rolling average trend, and when you look at it like this with the trend line drawn, it does look like it is going down. But if you look at it like this, we might ask, has the last 10 years been an anomaly where we drop below 2% and where we will eventually get back above it? So that's the real question. So there are four components to GDP growth: personal consumption, investment, government spending, and net exports. This is their share in GDP. Consumer spending has slowly climbed and is now close to 70% of GDP. Government share is declining. Investment is stable, but is really a function of consumer and government spending. And then net exports is a small deficit, but probably our best hope for reviving growth. The takeaway is that consumer spending is the primary driver of GDP growth at 70%, and it is also the primary driver responsible for the approximately 15% of investment spending. So we will focus first on consumer spending to see what's in store for future GDP growth. This is the 5-year rolling average of year-over-year change in personal consumption expenditures. You can see it is trending down. There are three primary factors that impact long-term growth in consumer spending: demographics, debt overhang, and productivity. Let's look at demographics first. Our population is aging, and people earn and spend differently at different stages in their life. This chart shows how expenditures on various items go down as people get older, things like clothing, transportation, and pension expense. The Bureau of Labor Statistics publishes income and expenditures for different age brackets. We combine this data with the Census Bureau population projections going forward to calculate the gross income and expenditures going forward up to 2040. It represents the projected income and expenditures in today's dollars going forward for the next 25 years. And you can see the compound annual growth rates for both incomes and population in the orange box at the bottom. The first 5-year annual change in incomes is 0.79%, going down to 0.58% in 2040. And most of that is just due to changes in population. If you look at the per capita growth rate, it is basically flat. So we have 0.80% population growth, and the impact of the change in composition of the population is basically minimal, just a few basis points. And the picture for expenditures is about the same, so we won't spend any time on that. And what this basically means is that we will have real growth in expenditures of about 0.70 to 0.80% per year, which is primarily a function of population growth. Population growth is lower than it has been historically. It used to be above 1%, but has declined. The trend is down, but it's not terrible. It's not Japan like some people have said. This is Japan versus the US. You can see that in the US we are still growing, but Japan is actually declining. So the analogy with Japan is misplaced. The next thing we will look at is the debt overhang. Basically, you need credit expansion to help facilitate growth, and we are at the tail end of the long-term debt cycle where we are still over-indebted at all levels of the economy. And so that presents a headwind to growth. I'll show you what that looks like. This is corporate debt to GDP. It's at an all-time high. Household debt to GDP has improved, but is still pretty high. Government debt to GDP is at an all-time high. And household debt service is reasonable at the moment because interest rates are low and debt levels have come down a bit, but that is still very susceptible to rising rates. To put it into historical perspective, in 1950, when rates were back where they are today, debt to GDP was 125%, and we went on to grow at a 4% real compound annual growth rate. Today, rates are low again, but debt to GDP is almost 3 times higher than it was in 1950. It is now at 325% of GDP. So the ability to grow credit is much more constrained than it was in 1950, and this presents a headwind for growth. Lastly, productivity as measured by real GDP per capita growth. The 40-year average has been about 1.78%, but the past 5 years have been minus 0.22%. So that has slowed. And generally, an aging population will have a lower productivity growth. And as Ray Dalio of Bridgewater has pointed out, previous productivity dips have been associated with credit cycle swings, which we are currently experiencing. So both demographics and debt are a headwind to productivity growth. So to sum up the health of the consumer, we know that population growth will give us about 0.70% per year in total real growth, not per capita. Population composition changes due to aging are insignificant. They vary only slightly from population growth itself, but they will affect productivity growth a little bit. So for the baseline, in the absence of productivity gains, we can expect to grow at an average annual rate of 0.70 to 0.80% per year, just based on population and changing composition of the population. Productivity is the unknown. The question is, will it revert to its long-term average of 1.78%? We don't know. To get to 3% real growth, like the title of this video asks, would imply productivity growth of 2.3%, which is even higher than that, so that is highly unlikely. Given the headwinds of demographics and debt, we might expect productivity growth in the 1% range, give or take 0.25%. So it seems prudent at this point for the next 10 years to assume 0.70% population growth plus productivity growth of 1%, give or take 0.25%, and so we estimate somewhere between 1.5% to 2% final real GDP growth going forward for the next 10 to 15 years. And that is in line with the estimates put out by the FOMC shown here. So that's it for this video. Thanks.